Good evening, ladies and gentlemen. Welcome to the Q2 FY26 earnings conference call of Ellenbarrie Industrial Gases Limited, hosted by Radhi Advisors and Motilal Oswal. As a reminder, all attendees will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. If you have any questions, please feel free to press the raise hand button. We'll call you on in turn and unmute your line so you can speak. Please note that this conference is being recorded. Kindly also note that the audio of the earnings call is a corporate material of Ellenbarrie Limited and cannot be copied, rebroadcasted or attributed in the PR media without specific and written consent of the company. Please note that anything said on this call that reflects the outlook towards the future, which can be construed as a forward-looking statement, must be reviewed in conjunction with the risk that the company faces. A copy of the disclosure is available on the investor relations section of the website as well as on the stock exchanges. To give you an in-depth understanding of the company and answer all your queries, we have from the management side today, Mr. Padam Kumar Agarwala, Chairman and Managing Director, Mr. Varun Agarwal, Joint Managing Director, and Mr. Srinivas Prasad, Chief Financial Officer. I now hand over the conference to Mr. Agarwala for his opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen, and thank you for joining us today. We are very pleased to share another good quarter for Ellenbarrie. The second quarter once again highlights the consistency and resilience of our core gases business, which continues to be the main driver of our growth and profitability. To set the context, our reported revenues for the quarter stood at rupees 892 million, reflecting a 6.7% increase sequentially. On a like-for-like basis, excluding the one-off project engineering revenue that was part of the base last year, our revenues from sale of gases grew by nearly 10% year-on-year. This growth underscores how the gases business serves as a direct proxy for the broader expansion of manufacturing activity in India. And that link remains a fundamental strength of our model. It is also worth reiterating that the revenues from the project engineering division are lumpy. While it contributes periodically, the core business driver will continue to be the gases business. EBITDA for the quarter stood at rupees 337 million, maintaining a stable margin of 38%, which we view as a clear validation of our operational discipline and cost management. Our profit after tax at rupees 367 million, representing a 96% year-on-year increase, reflects not only the underlying operating strength, but also our continued focus on optimizing capital efficiency and strengthening the balance sheet. I now hand over to Mr. Varun Agarwal to go through the results in detail.
Thank you for that. So operationally, this quarter marked important progress for us. We successfully ramped up operations at our Kurnool and Tata Steel Metallics plants. Our merchant plant in East India is on track to go live end of this month. We also expect to commission our new on-site plant in East India by March 2026, followed by another merchant plant in FY27. These expansions will take our total owned and operated capacity to 1,910 tons per day by end of this financial year and over 2,100 tons per day by end of next financial year, enabling us to serve a more diversified set of industries and geographies. From a strategic perspective, we continue to pursue a balanced growth agenda, combining organic expansion while remaining fully open to inorganic growth through acquisitions. We are strengthening our distribution infrastructure and focusing on high-margin value-added gases such as argon, which now contributes 13% of our total revenues. However, prices of argon, which while we are bullish on them in the long term due to structural demand-supply issues may exhibit short-term fluctuations. Looking ahead, we remain very optimistic. The Indian industrial gases sector is poised for strong growth, driven by demand from steel, pharmaceuticals and chemicals, healthcare, and emerging areas such as semiconductors, green energy, and space research. Ellenbarrie, with its 50-year legacy, pan-India ambitions, and disciplined capital allocation, is well positioned to capture these opportunities while maintaining financial prudence and shareholder value creation. We expect to grow at a CAGR of 20 to 25% over the next 4 to 5 years in our core gases segment, considering the last full year financial numbers as a base, and all this while maintaining EBITDA margins of around 40%. Since this is a long-term business driven by long-term contracts, we would encourage our investors to look at us from a long-term perspective and not to look at quarterly aberrations, if any. Thank you, and we now look forward to discussing our performance and outlook in greater detail through the course of this call.
Thank you. We will now open the call for questions. Kindly raise your hand to ask a question. We will unmute your line. And as a reminder, we request all participants to restrict themselves to 2 questions and come back in the queue. The first question is from the line of Mr. Ashok. Can you please unmute yourself and go ahead?
Yeah, hi, good afternoon. Thanks for the opportunity and congratulations for the great set of numbers. So my first question would be, I have 2 questions actually. The first question would be on the recent GST changes. So would like to understand the recent GST changes will have any the cost pressure impact on us. That's my first question. And second question, coming to the revenue guidance, as you mentioned at the start of the call, it would be between 20 to 25%, which is a slight change when compared to the previous guidance given in the initial conference call. So what we understand is that in the previous call, the guidance was about 25% at least revenue growth we are expecting for the next 2 to 3 years. So is there any change in the guidance? If yes, and would like to know the reasons behind it. That's it. Thank you very much.
So thank you for that question. So on your first question on GST changes, so our industry, while on the, so we have 2 segments in the sense that we sell industrial gases and medical gases. While there is no change in the GST on industrial gases, but for products such as medical oxygen, the GST has actually been reduced from 12% to 5%, making it, of course, much more affordable to our end-use customers. And of course, this is such a critical product that we manufacture. So, we are thankful to the government for recognizing this and bringing down the GST to 5%. In terms of the revenue guidance, our guidance of 20 to 25% is purely on the core gases business. Any number which was shared earlier would have been, with respect to the overall revenues of the company. However, as we mentioned that project engineering revenues tend to be quite lumpy, I would, encourage investors to track the revenue from gases because that's the core business. And, if we add in some revenue from project engineering, then yes, I think what we said earlier continues to remain. But from the core gases business, we would get a 20 to 25% CAGR. Anything over and above that is possible with contribution from the project engineering.
Okay, sir. Thank you very much. Just a follow-up on that. Would you throw some light on the on-ground demand and outlook on the second half of the year? Because as we see, there is a good amount of ramp-up of capacities happened. So just would like to know the outlook on the second half of the year.
So look, in terms of our capacity, we've got whatever our existing capacities are there. Those are more or less, fully ramped up. There's very limited spare capacity that we have. Of course, we are coming up with new capacity, which is going to be one at the end of this month and one at the end of the financial year. The capacity which is coming in end of this month, we have good visibility in terms of, demand, and we expect a quick ramp up of the capacity utilization there primarily because it's also in one of our core markets in East India. And the second capacity which we are coming with at the end of this financial year, that's a contracted capacity with a single customer, where our revenues will not be dependent on the capacity utilization. So we are not too concerned about the capacity utilization there. It's a sort of a long-term contract with a fixed fee every month.
Okay. Thank you, sir. So what about the Tata Steel plant commercialization? From when it will start?
No, that is already up and running.
That's already up and running. Thank you, sir.
Yes,
Thank you very much. That's all. I will follow up in the queue. Yeah.
Participants, to ask a question, please raise your hand. I have a few questions in the chat. Varun, I'll go ahead with the chat questions. Argan contributed around 10% of revenue last quarter with 37% EBITDA margins. Where does the Argan mix and margin percentage stand now? And can it reach till 15% plus of sales with higher margins by FY27?
So Argan was 10%. I think, we've now reached about 13%. I think long term, this number, we do expect it to inch up. While we don't want to give specific guidance on Argan margins and Argan contribution, but I think broadly, we want to make this comment that yes, this is a focus area for us. We do see long-term solid growth in Argan demand, and it will continue to remain a focus area. The margins in Argan are definitely higher than our other gases, and it is a key driver of our overall EBITDA margins for the company. So while we are talking of a 40% sort of EBITDA margin long term, and we are already very close to that number, we don't have any specific margin number for Argan, except to say that if the EBITDA margin for the company as a whole is 40%, then Argan EBITDA margins will definitely be higher than 40%, because that's the higher margin product. But more than that, we are not sort of commenting on specific product margins on a sort of forecast basis.
Thank you for that answer. The next question is, with semiconductor and electronics manufacturing rising in India, are we developing specialty gas grades or supply chain for this segment? And what kind of margin percentage can such gases command versus core products?
Sure. So we are gearing ourselves to cater to these segments. I think, while we tend to put both of these into the same bucket, I think what's happening is that the solar cell part of it is, already happening as we speak. Semiconductors is still going to take a little bit of time before we get meaningful gases demand from the semiconductor industry. But on the solar cell part of it, we have capabilities to supply ultra high purity gases such as ultra high purity nitrogen, ultra high purity oxygen. There are a few other gases like silane, like ultra high purity ammonia, ultra high purity nitrous oxide. These gases are typically imported and sold. We are in discussions with multiple solar cell manufacturers with whom we already have existing relationships through supply of certain gases that we manufacture to provide a holistic solution to them by supplying the remaining specialty gases through import and sale. And we've also tied up on this account in terms of our supply chain. The margins here, at least for the manufactured products that we are making in-house, will be significantly higher than the average company margins. But however, for traded products, of course, because they are traded products, naturally the margins would not be as high as a manufactured product. But it would still, probably be in somewhat of a 15 to 20% kind of a margin on the traded products.
Thank you. Thank you, Siddhant. Our next question is from Mr. Sumant Kumar. Sumant, I've got you on screen. Please unmute yourself and go ahead with your question.
Yeah, Varun, can you hear me?
Yeah, hi Sumant, I can hear you.
So Varun, my question is again on opportunity in solar cell value chain. We have seen in India is developing and we have higher expansion in that segment. Second is electronic, the semicon value chain is also creating. And so when you see the two big opportunities, solar cell manufacturing as well as electronic manufacturing value chain. So what are the key gases you are targeting and how is our plan for these two segment industrial gases going ahead? And what is our expansion plan we have?
So our idea is to, so there are two types of gases broadly, right, which they require. One is the ultra high purity air gases, which means the air separation gases which we are already manufacturing, but in an ultra high purity level of purity. So, which means like 99.9999%. So we have now built the capability to supply these ultra high purity levels of gases. The other set of gases are gases like which are not coming from the air, so which we are not manufacturing, but which will be either predominantly these are imported gases. So for those, what is important is to have a proper supply chain setup, which means having warehouses in every region which can cater to the local customers. And we are well on our way to setting some of these up. So our idea is, of course, we do see this as a strong growth potential going forward. And we've been working on a number of these contracts. We've actually last quarter also closed about 3 contracts in this space. And, the number of inquiries in this space is actually phenomenal. It's like more than I've ever seen. So yes, this will continue to be focus point for us. And, you will definitely expect to hear more news from us, over the course of the rest of this financial year on this side, because this is right now a very hot space.
So can you talk on what other gases is required for separately for solar and solar cell and or semicon or electronic manufacturing industry, and Yeah, Varun.
Yeah. So see, for solar cell, primarily, apart from this ultra-high purity oxygen and nitrogen, you require silane, you require ammonia, you require nitrous oxide. These are some of the gases that solar cell companies require. When it comes to semiconductors, I believe that the total requirement can stretch to as many as 40 to 50 different gases. Um, so, of course, immediate focus area for us is are the solar cell guys. We are building capability and storage distribution capability as well as manufacturing capability for some of these gases.
Two things. One is the current requirement and new trend of requirement of new gases. So we need to develop our capability in that and expertise in that. Number two, we need a geographical expansion also. So assuming all the cluster, and you also see how the solar panel expansion is happening in India. So to say mid part of India, north part of India, we are already in east side. So where we are seeing a more opportunity and where we are lacking, where we want to fill the gap in the geographical expansion also.
Absolutely. I think that, geographical expansion is one of the key focus area for us now, because ultimately we want to be an all India company, and, we've already started work on plants outside our core geographies in east and south. And, at the appropriate time, of course, we will make the disclosures. But, be rest assured that we are looking at geographical expansion very seriously. We do understand a lot of this growth is coming, especially in Western India. Some of it is also coming in Central India, some in North India. These are areas where we have historically not been present, but we are actively looking at all these areas. And, there are certain plans in place for us to become a pan-India company, over the next couple of financial years, so that we can capture growth across all regions.
So you were talking about the warehouse, and you need a warehouse for importing gas and supply to say semicon industry and say maybe a solar companies. So are have we started making warehouses and planning in our expansion stage? We are.
Yeah. So these warehouses will be built in in our plant facility only. It's not like such a huge warehouse for which we need separate land. We will be building it within our sort of existing facilities, and as well as the expansion facilities in the new geographies. This warehouse has to be basically compliant with all the regulations, because a lot of these gases are, quite difficult to handle. And those will be built within the expansion projects. And in fact, one warehouse we are now starting work in one of our existing locations. So, we will basically, and this is required for the last mile delivery,
So is there any packaging also in that when we are buying from the global market and storing and then packaging it and selling to that your customer?
This will be in a smaller package than the imported. Like the imported material will be in bigger sized package. This will be in a smaller sized package typically.
And how logistic will work?
Means that the gas will be imported in that bigger package, in bigger containers.
Local logistic I'm talking about.
Local, then that it will be sort of transferred into smaller sized containers, and then whenever the customer requires, then the small sized container will be given to the customer.
See, the quantity is lower, so we need to have a warehouse near to their plant, or maybe if the distance is higher, maybe that will be the cost will be higher in that case, the freight cost. That will be a challenge, right?
Well, I'll take this. It all depends on the cost versus payback. So for small consumptions, having a warehouse again would be. I mean, we'll have to look at it from the cost and payback basis. We are looking at different options on this. So the business plan is under preparation, and maybe we'll have more clarity on exact locations, etc. In a few months from now. Right now, we've taken an in-principle decision to have warehouses in our existing and upcoming plants. Standalone warehouses don't justify the business volume.
Okay. So we can see in
Sumant,
next 3 years. Last question. We can see in next 3 years we have a decent contribution of solar and electronic manufacturing segment.
Yeah, we are working on those plans, and definitely solar gases for solar and semicon would be a bigger part of our kitty in times to come.
Okay. Thank you.
Thank you.
Thank you. I'll take the next question from the chat. What is the current status of the hydrogen electrolyzer pilot? Any commercial orders or learning so far? And what could be the potential margin profile if scaled?
Sorry, Vinita, can you repeat that? Couldn't hear you clearly.
I'll repeat. What is the current status of the hydrogen electrolyzer pilot? Any commercial orders or learnings so far? And what could be the potential margin profile if scaled? Was that clear?
Yes, clear.
Okay.
So, look, the hydrogen electrolyzer, while it's a pilot, we should also be clear that our view on hydrogen and this, the kind of hydrogen business that we want to do is not similar to the hydrogen business that the sort of large energy companies want to do. For us, hydrogen is just another gas in our portfolio of gases. We will supply it to, our customers across various industries, like, typically it could be pharmaceutical companies, it could be, edible oil companies. So we are not in that hydrogen as an energy resource kind of space. Having said that, yes, hydrogen, the hydrogen electrolyzer is also, capacity there is being ramped up. And, of course, while it still remains a very small business, but, this is something that we want to replicate whenever we are setting up our air separation plants in future. We also want to have a hydrogen electrolyzer along with it in the same premises, just because it adds to our kitty of gases. We don't foresee hydrogen to be a very meaningful contributor to the overall revenue. I think those will still continue to be driven by the air separation gases.
Thank you. That was quite insightful. The next question is, Kurnool was around 60 to 65% utilized in Q1. So have we reached 85 to 90% now? And are the East India merchant plant and on-site projects still on track for October and March commissioning?
Kurnool is, the ramp up has happened beyond 65%, which was in Q1. Now we'd be at a number which is, closer to 75-80%. So that's on track, as we had alluded in our opening remarks. Also, I think in the opening remarks we had mentioned that the merchant plant in the east is expected to commence end of this month. So there's been about a delay of a month or so. And the east on-site expected to commence end of this financial year. The next merchant plant, which we had originally guided for, Q2 or so of next year, is now pushed to second half of next financial year. So, we've seen small delays in terms of execution, and I think, I would say that this is one of the key risks that any growing business in our sector faces, which is this small delays in project execution. While it doesn't change the long-term trajectory of the business, I think on a shorter-term basis, you may find that a revenue which was expected to come, let's say in Q3, will come in Q4 and things like that. But I think, as I mentioned, I think the long-term growth story is intact. We are putting up capacity, and these 3 plants which we are talking about, the 2 merchant plants and 1 on-site, that's not the end of the story. We've got a lot more things which are planned, and we have a sort of a long-term vision of growing at this 20 to 25% in our core gases business, which would require us to set up more plants. So important thing is to look at it on a longer term basis than a quarter by quarter basis, because project implementation may have slight delays depending on the project.
Okay, thank you. Has a site or customer been finalized for the proposed Western India expansion, and will it follow a merchant or on-site model?
So we are looking at West as a merchant model. I think there's significant demand there, a lot of new industries coming in as well. Site for the plant has more or less been finalized, but I think we are not in a position to make an announcement yet because it's not been sort of 100% finalized. But I'm hoping that next time we speak to the investors, we will be able to share that exact location.
Okay. The next question is for the new 220 TPD plant. Earlier guidance was around 160 crore capex for 100 to 120 crore annual revenue. Does that ratio still hold, or are newer designs improving returns and power efficiency?
So I think this 220 plant is anyway, about to be commissioned. So, capex is obviously frozen. Revenue from that plant, I think the revenue potential of 100 plus crores, still holds. So I don't think there's any significant change in terms of new design or anything like that. And as I said, the capex is most of the capex has already been done, and we expect to commission and get the production by the end of this month. We've in fact also received, for us, the power connection is the sort of main, it's a significant milestone in terms of our commissioning, the plant power connection. Before that, we only get this construction power. So we've also received the plant power connection, and now it's just a matter of connecting everything up together and pressing the start button, basically.
Okay. The next question is, there is some delay in execution of North India capacity, as in the Q1 Concall you said Q1 FY27, but in the Q2 PPT you mentioned H2 FY27.
Yes, that's correct. And I sort of covered that earlier in my earlier answer as well. There is a slight delay. And as I mentioned that, when it comes to project execution, while we endeavor to complete all the projects as per the schedule given, but there may be delays, doesn't change the long-term outlook of the business. But on a short-term basis, it may have a small impact. But long-term, look, we are very confident of not just that one merchant plant of FY27, but to put up more plants across the country and working actively on setting up multiple capacities.
Okay, thank you. What is the capacity utilization for Q1 and Q2 for FY26?
So look, broadly, we were fully utilized across all our plants except the recently commissioned Kurnool plant. And that has gone up, from Q1 to Q2, as I had mentioned in one of my earlier answers. Apart from that, most of our other plants are running at pretty much full capacity.
Okay. What is the reason for falling the revenue on YOY basis, and if you can provide location of North India capacity?
So, Y-on-Y basis, as we had mentioned, there's a last Q2 of last financial year, we had booked a revenue of about 150 million from project engineering. The way project engineering works is that you keep executing a project. This is basically sale of projects to customers, sort of like an EPC business. So you keep doing the work, but then you take the block revenue booking in one particular quarter. And so then that quarter looks little distorted. So I think the correct way to look at it is to look at the revenue from the core gases business. So if you strip out that 150 million of revenue from project engineering in the last financial year Q2, then there is a growth in revenue, in fact, of about, I think, close to 10%.
Okay, thank you. The next question is, since the revenue growth has been around 8% for H1, is H2 going to be much stronger to achieve that 20 to 25% growth?
So H2 will be stronger just from the fact that we have new capacity coming in. So we would expect H2 to be stronger. And again, I want to reiterate that, this 20 to 25% growth is slightly longer term growth CAGR. So, as I said, there can be short-term aberrations, but given the type of capacities and capex that we are planning, this is a longer-term growth target which we have. But yes, H2 should be better, just from the fact that capacity ramp up of existing production should continue, and as well as, the new capacity should kick in. So both of those should contribute.
Thank you. What is the management's CAGR vision for revenue and profit growth for next 3 years? Is it below 25% or above?
So same, you answer this question. Same sort of, as I mentioned, 20 to 25% is a revenue CAGR over sort of 4 to 5 years. I don't think I want to get into like a 2-year, 3-year sort of a number, but I think a long-term guidance is 20 to 25% from the core gases business, and an EBITDA margin of around 40%. And we are, on the margin side, we are obviously there or thereabouts. And so the idea is to keep growing the revenue while maintaining this similar sort of EBITDA. Maybe that will inch up a little bit more, the EBITDA margin, but near about we are there.
Thank you for that. Kindly raise your hand to ask a question. Participants, if you have any questions, please raise your hand. Since there are no further questions, I would like... Sorry, there's one question. Any plans to enter Gujarat or Maharashtra?
Yeah, so we have a plan to enter Western India. We can't share the location at this stage precisely, but plans are there to enter Western India, and at the appropriate time when we are able to make the disclosure, we will share it with you.
Thank you.
Vinita, you should read this
Yes,
comment
sir.
also.
Okay. Sumant, you're on screen. You can unmute yourself.
Yeah, Varun, can you talk on argon gas price decline? How is the trend outlook? What are the key factors to drive going ahead?
I see argon price decline. If you are comparing between Q1 and Q2, I don't think there is anything, any sort of decline in argon price. I think long term. So Q2 of last year, the argon prices, there was an abnormal spike. That was a bit of an aberration in Q2 of last year. But, on a normalized basis, that's why I'm saying, see, quarter on quarter, if we start trying to analyze argon prices, then even we don't have an answer. Okay, because we are sort of looking at longer term trends rather than quarter on quarter price movements, because it's like stock market. Every day you cannot analyze why it moved up or down, right? But long term trend you can give. So it's like similar thing that we can't give a quarterly why price moved up, why price moved down, but longer term, yes, we continue to remain bullish. And the reason is very simple. Okay, argon demand is increasing faster than the argon supply, and you cannot set up argon supply, just argon supply cannot be set up, right? Your whatever argon supply comes is like a byproduct of your oxygen production. So, oxygen production growth rate will determine the argon production growth rate, and argon demand is growing up like very fast. You spoke about that solar cell. Now, what is the next step for all these solar companies? The next step is all these guys are going to go into ingots. For this ingots, you need huge amount of argon. So structural demand for argon is very strong. Demand is going to outpace supply, and that is why long term, we remain bullish on argon. But short term, of course, see, very difficult to say. But again, our sales are not purely determined by short term prices, right? So that is another caveat I want to share, that we have contracts also in place. So while short term there may be volatility, we have contracts in place, and we are not our 100% of our production is not exposed to the short term price movements.
But oxygen nitrogen price has also corrected YoY basis. So compared to previous year, how is the demand of industrial gases? the demand, is there moderation in demand? That is why the nitrogen oxygen price is corrected?
So demand is strong, right? We've also, we've got to keep in mind that power prices have also corrected, right? So power pricing is at a multi-year low. Given that even if prices correct, our margin remains protected. Ultimately, our goal is to protect the margins. So, and the nature of the industry is such that the margins will remain protected. If today power prices shoot up, if diesel prices shoot up, then our end product cost will also shoot up.
Okay, Varun. Thank you.
Thank you.
I'll take the next question. What is the expected growth rate in sales in FY26 as compared to FY25 after addition of new plant? Any exit number you are targeting in terms of turnover for FY26, if there is any range which you can give?
So look, I think just to be consistent, we want to guide on a long-term basis only. I think this is the right way to look at our business. I think there's a comment. What is the expected? In case there is more argon to be produced because of increased demand, will it not lead to higher oxygen production and hence lower oxygen prices? So, Nikhil, that was your question. And the answer is that you cannot produce more argon because unless there is demand for oxygen. It doesn't work the other way around because, the quantum of argon which you get is hardly 4 to 5% of the quantity of oxygen that you produce. So just for that 4-5%, you cannot set up a capacity just for that 4-5% because then what are you going to do with the rest of the product, which is the bulk of your production and cost? So it doesn't work the other way. It generally is that, okay, whenever there is an oxygen demand, you set up a capacity and you get argon as a byproduct from there. From a viability perspective, the other way around does not work. Coming to your next question about guidance, again, just to be consistent and, to reiterate, I think we are looking at a long-term guidance, over 4 to 5 years with last year as a base because last year was the last full year number available. Based on that full year number, we are looking at a 20 to 25% CAGR just on our core gases business. I don't want to give sort of short-term guidance, but I think longer-term guidance is intact. We are coming up with new capacities. There are multiple expansions. Of course, 3 plants are already being constructed. There are multiple more which are on the drawing board, which we will keep announcing to you, in future quarterly calls. So, we are well on our way to achieve that number. We have plans in place, but we would not like to give a quarterly guidance or a sort of half-yearly guidance.
Participants, if you want to ask your question, kindly raise your hand. There's one question. We are expanding in the western part. So what are our plans to penetrate the market given the already present vendors there?
So, vendors are there all over the country, right? But then the point is that the market is also expanding. So, if we are able to set up a plant which has efficient cost of production, then there is no reason for us to not be able to capture the increase in the market, right? And then there are certain customers with whom we already have relationships in other geographies who have other production in Western India as well. Maybe a second plant is there in Western India. Those customers, there we have direct access, we can come in as a second supplier. So there are multiple strategies. Of course, we are not going to deploy, significant capital unless we have a fair degree of confidence that we are going to be able to sell the product. So, be rest assured that if the market is growing, right, there is enough room for capacities to expand and for everyone to get a piece of the market. So the problem happens is that the market stops growing. But because our industry is such that we supply to a multiple variety of sectors and we are so closely linked with the overall manufacturing growth of the country. So in that sense, we are quite secure. I mean, today, if there is a collapse in manufacturing across the country, so that's of course a macro India level risk. Then we'll be exposed. But at a micro level, we are not exposed to risks because we are diversified and supplying across multiple sectors. So market is growing. We'll come in. We'll also take a piece of the growth of the market. And anyway, we are not saying that, on day one, we'll sell everything, right? It's a gradual ramp up, which takes 1.5 years, 2 years. And, that's built into our financial calculations while setting up a plant.
Since there are no further questions, I would like to hand over the call to the management for their closing comments. And one more statement. Best of luck. You are a truly visionary leader.
Okay, I think that's a good enough closing comment, Vinita. But no, thank you everyone for joining this call. We look forward to continue this growth journey. We'll be happy to, engage with all the investors on a regular basis to address the queries. And, thank you for attending the call once again.
Thank you.
Thank you once again for your time and participation. On behalf of Ellenbarrie Industrial Gases, this concludes today's conference. For any questions, please feel free to write to us on email IDs mentioned on the invite. We appreciate your engagement. You may now disconnect your lines. Thank you, Varun. Thank you, Padamji.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.